Hello and welcome back to the QuantScore Financial Show, brought to you by Math and Maticians. Politics is a grand spectacle filled with rousing speeches, intense debates and carefully crafted public images. It's a world where words are wielded like weapons and promises are made with a flourish. But the real insights, the truly revealing glimpses into the minds and motivations of our leaders, often come from a much quieter, more unassuming place: their financial disclosures. These documents, often overlooked in the daily news cycle, hold a wealth of information. These legally required documents reveal not just a surface-level transparency, fulfilling a basic requirement of public service, but the true financial philosophies, the underlying principles that guide their decisions and shape their understanding of wealth and value of our leaders. Think of them as a peek into a politician's private library, a collection of their most closely held beliefs and priorities reflected not in words but in assets. What they choose to invest in, the sectors they bet on, the risks they're willing to take. All of this says far more than any carefully crafted campaign slogan ever could. It reveals their true beliefs about the future. Disclosures are, of course, primarily meant to prevent conflicts of interest, ensuring that our elected officials are acting in the public's best interest, not their own. But beyond that, they also offer a fascinating window into how politicians manage their own money, the very resources they've accumulated and are responsible for growing. Are they risk-takers, boldly venturing into new and potentially lucrative markets? Or are they cautious savers, prioritizing stability and security above all else? Their portfolios, meticulously documented and publicly available, reveal their real-world approach to wealth, their personal philosophy on how to build and maintain financial security. Today we'll delve into the latest disclosures from Senator Rick Scott of Florida, a prominent figure in national politics. We'll also examine the holdings of Representative Suzan DelBene, a congresswoman representing Washington state. And finally, we'll scrutinize the investments of Representative Moskowitz, another influential voice from Florida. Their choices, ranging from the steady, reliable returns of government and municipal bonds, often seen as safe havens in turbulent times, to the dynamic, high-stakes world of individual stock trades, a realm of potential gains and equally significant risks, offer a fascinating and insightful study in investment strategy, revealing their individual approaches to navigating the complex world of finance. By carefully watching how these public figures allocate their capital and make their investment decisions, we can demystify the often intimidating world of finance, breaking down complex concepts into understandable terms. And ultimately, we can learn practical lessons and gain valuable insights that can be applied to our own personal investment strategies and portfolio building efforts. So let's dive in and begin our exploration of the financial lives of these prominent politicians. We're starting with the most classic of investments, the municipal bond, a cornerstone of many portfolios. Let's see what these choices reveal about the people who make them and what we can learn from their financial decisions. Our first stop is Florida, where Senator Rick Scott's latest disclosure filings offer a glimpse into his investment strategies. These disclosures, required of public officials, provide transparency into their financial dealings, revealing shifts in their portfolios and offering insights into their financial priorities. The documents reveal the purchase of a municipal bond. This particular investment choice speaks volumes about his current financial outlook and risk tolerance. A municipal bond, often referred to as a muni bond, is essentially a loan to a government entity. This could be a state, a city, or even a local government agency. When you buy a municipal bond, you're lending money to that entity. These bonds are generally considered safe, steady, and favored by those who value stability and predictability in their investment portfolios. They are a cornerstone of many conservative investment strategies. Scott's bond comes from the Oklahoma State Water Resources Board, indicating a specific investment in the Sooner State. This is a body managing a resource as essential as water, highlighting the critical infrastructure that underpins our society. Water is, after all, a fundamental need, making investments in its management relatively secure. This isn't a speculative tech bet chasing high growth with inherent risks. It's an investment in public infrastructure, the kind of essential services that communities rely on every single day. It's promising reliability over excitement, a calculated move towards long-term sustainable returns. The bond pays 5% interest, a respectable yield in today's market, especially considering the low-risk nature of the investment, and matures in 2041, a long-term commitment that spans nearly 2 decades. This offering predictable income for years to come, making it an attractive option for those planning for retirement or other long-term financial goals. It's the financial equivalent of a loyal old dog, dependable and unlikely to cause worry, providing a sense of security in an often turbulent financial landscape. Such investments are for those who prioritize wealth preservation, focusing on protecting their assets rather than aggressively growing them. By choosing a municipal bond, Scott signals a conservative long-term approach to managing his wealth. It's a strategy rooted in trust for public institutions, reflecting a belief in the stability and reliability of government-backed investments. Senator Scott didn't just buy a bond for himself. He bought an identical one for his wife, Anne Holland Scott. This move highlights how personal finance often involves the whole family, aligning goals and strategies. By mirroring investments, both benefit from the same stable income-generating asset. It's a simple way to ensure equal footing and shared security in household finances. The 5% Oklahoma bond offers Mrs. Scott the same predictable long-term income. For those who prefer a set-it-and-forget-it approach, it's ideal. Steady, low-maintenance, and reliable. This dual purchase underscores the Scotts' focus on safety and stability. Their strategy is clear. Preserve wealth, avoid unnecessary risk, and build a solid financial foundation. It's a picture of domestic financial harmony, built on the unglamorous but sturdy base of municipal bonds. A practical, unified approach to family wealth. Now let's cross the aisle to Representative Suzan DelBene of Washington, whose portfolio echoes Scott's conservative approach. DelBene, a former tech executive, also favors municipal bonds, proving good strategy transcends party lines, or that these congressmen and congresswomen have absolutely no faith in the market over the next couple years, especially given the size of their investments. Her bond comes from the University of Texas System Board of Regents, another large, stable public institution. Lending to a major university is a bet on stability and the enduring value of education. The bond pays 5% and matures in 2036. A patient, long-term investment. DelBene's choice aligns her finances with the public good, supporting education while securing reliable returns. Parallel with Scott is striking. 2 politicians, different parties, same strategy. Both have chosen the quiet reliability of municipal bonds over the volatility of stocks. It's a reminder that beneath political differences, the fundamentals of prudent finance are universal. Sometimes the safest path is the one most widely traveled. Let's quickly demystify this 5% bond business. What does it really mean to invest in a bond that promises a 5% return? We'll break down the basics, so you can understand exactly how these financial instruments work and whether they might be a good fit for your investment strategy. When you buy a bond, you're essentially lending money to the issuer, which could be a corporation or a government entity. In return for your loan, the issuer promises to pay you interest. In this case, 5% annually on the face value of the bond. Think of it as a formal IOU with a guaranteed interest rate. So, let's put some numbers to it. For every $10,000 invested in this 5% bond, you can expect to receive $500 a year in interest payments until the bond matures. This is a fixed income stream providing a predictable return on your investment. Unlike stock dividends, which can fluctuate based on a company's performance and decisions, these bond payments are contractual. This means the issuer is legally obligated to make these payments according to the agreed-upon schedule. Reliable, rain or shine. That's precisely why bonds are so attractive to those seeking predictability and stability in their investment portfolio, especially as they approach or enter retirement. The consistent income stream can be a valuable asset for managing living expenses and ensuring financial security. Now, it's important to understand that bond prices can fluctuate with prevailing interest rates in the market. When interest rates rise, the value of existing bonds with lower interest rates may decrease, and vice versa. However, if you hold the bond until its maturity date, you're guaranteed to get your initial principal back, regardless of any price fluctuations that may have occurred during the bond's term. For long-term investors like Scott and DelBene, who are primarily focused on generating a steady income stream, these daily price swings in the bond market are often less of a concern. They're primarily after a steady and reliable income stream, not the potential for quick and substantial capital gains that you might seek in the stock market. Therefore, choosing a 5% municipal bond represents a deliberate decision to prioritize certainty and stability over the higher potential returns, but also higher risks associated with other types of investments. It's about locking in a known and predictable return on your investment and building a solid and dependable financial foundation that can withstand market volatility. For new investors who are just starting to navigate the world of finance, it's crucial to remember that. Sometimes the most successful and resilient investment portfolios are built on a foundation of reliability and consistency, rather than chasing after high-risk, high-reward opportunities. Bonds, with their predictable income streams and relative stability, can serve as the cornerstone of a stable and secure financial future, providing a solid base for long-term wealth building. Now, for a change of pace, let's look at Representative Moskowitz of Florida, who's taken a very different approach. While others sought safety in bonds, Moskowitz was actively trading healthcare stocks. His recent disclosures show a strategic shift within the healthcare sector, not abandoning it, but recalibrating his bets. He sold his entire holding in one healthcare giant and bought shares in two major competitors. This is active portfolio management, rotating investments based on new opportunities. Such moves suggest confidence and a specific view on which companies will lead the sector. Unlike bonds, these trades are about growth potential, not guaranteed returns. It's a higher risk, higher reward strategy for those seeking to grow wealth, not just preserve it. Let's dig into the details of Moskowitz's healthcare shuffle. What prompted this bold move? Moskowitz's first step was selling all his shares in United Health Group, a healthcare titan and stock market favorite. United Health is a blue chip, dominant in insurance and health services. Selling such a reliable performer is a significant decision. Why sell? Perhaps he saw slowing growth, overvaluation, or looming regulatory risks. The healthcare industry faces increasing scrutiny and potential legislative changes. Sometimes selling a winner is about managing future risk, not just chasing past returns. It's like leaving a beautiful house on a cliff before the erosion starts. Moskowitz's sale was a tactical retreat, freeing up capital for new opportunities. It's not a bet against United Health, but a move toward what he sees as better prospects. Next, he redeployed that capital into two new healthcare bets. With cash in hand, Moskowitz bought shares in the Cigna Group and HCA Healthcare. This move diversifies his portfolio, spreading risk across two companies instead of one. Cigna, like United Health, is a major insurer, but perhaps Moskowitz sees better value or growth potential there. HCA Healthcare is different. It operates hospitals and care facilities, focusing on direct patient care. By investing in both, Moskowitz covers insurance and healthcare delivery, capturing multiple growth avenues. This strategy balances exposure to different parts of the healthcare sector. If one faces challenges, the other might thrive. It's a more sophisticated, resilient approach than betting on a single giant. Moskowitz's new portfolio is positioned for both stability and opportunity within healthcare. A smart play for a changing industry? What can we learn from Moskowitz's portfolio shuffle? His move from United Health to Cigna and HCA is classic active management, seeking new growth while managing risk. Diversifying across subsectors can yield better results than sticking with one big player. By rotating into less obvious choices, he's aiming for alpha, returns above the market average. It's a forward-looking strategy, betting on tomorrow's winners, not yesterday's. Splitting investments between an insurer and a hospital operator insulates against sector-specific risks. If regulations hit insurers, hospitals might benefit and vice versa so. This approach requires research, conviction, and adaptability. For everyday investors, the lesson is clear. Sometimes a well-timed shuffle keeps your portfolio ahead. Don't be afraid to rethink your strategy as the landscape changes. As for our perspective on the matter, our quant scores for the three companies this week reflect a different outlook and predictions on the future value of the companies. Before we get to the quant scores and our evaluation, we want to first mention this is not financial advice, nor is the rest of this video. Also, our quant score is simply done with basic algorithms compared to the vast amounts of information that flows through the halls of Congress. With that said, our quant score this week for United Health, Cigna, and HCA Holdings reflect a different outlook on their financial future than the Congressman's view on the companies. Our quant score this week currently has United Health Group undervalued with a quant score of 22. This is reflective of a strong price-to-earnings growth ratio of 0.82, forward price-to-earnings of 13.51, and positive metrics for both quarterly earnings growth and quarterly revenue growth. The company's stock has taken an absolutely beating over the past few months, and we feel the decline in their stock price is reflective of any fall in their financials. As for Cigna Group and HCA Holdings Inc., we have them both labeled as overvalued this week, but with Cigna coming in at an extremely low quant score of 2, expecting little movement in the coming weeks, while HCA Holdings came in with a quant score of 12. Our main prediction for this discrepancy seems to be the differences in price-to-earnings growth ratios of the two companies, with Cigna at 0.62, while HCA is just more than double that, sitting at 1.25, expecting minimal growth compared to that of Cigna. As it currently stands, our target prices for the three companies Senator Moskowitz has invested in, United Health, Cigna, and HCA. We have them expected at $430. An expected climb of 39% for United Health. We have expected to drop approximately 6% to around $300 for Cigna, and a worst-case scenario for HCA at a decline of 26% down to $280. Our tour of politicians' portfolios reveals two distinct investment philosophies. Scott and DelBene chose the steady path. Municipal bonds for safety, income, and peace of mind. Their approach is about preserving wealth and weathering market storms. Moskowitz, meanwhile, embraced change, actively rotating stocks for growth and diversification. His strategy is dynamic, seeking new opportunities and managing risk through diversification. The key takeaway: there's no single correct way to invest. Investors and speculators have both gotten rich and gone broke with a variety of different investment strategies. Your best strategy depends on your goals, risk tolerance, and time horizon. Are you seeking stability, or are you ready to chase growth? These disclosures show that even public figures make relatable, thoughtful financial decisions. Whether it's bonds or stocks, the principles remain the same. Make choices that secure your future. Investing isn't about complexity, it's about clarity and purpose. And that's a lesson worth remembering for us all. Thank you so much for watching. If you enjoyed the video, please hit the thumbs up button and subscribe to the channel to stay up to date on all things mathematical and financial. Thanks again, and until next time, stay calculating, my friends.